Everyone watches the stock market. When stocks go up, the news celebrates. When stocks crash, headlines panic. But what if the real danger to the global financial system isn't the stock market at all? What if the real risk is hiding in a market most people rarely talk about? The bond market. The truth is, the bond market is far larger and far more important than the stock market. And right now, warning signals are starting to flash. Stay with us until the end of this video, because understanding what's happening in the bond market could completely change how you see the global economy. And if you enjoy videos that explain complex world issues in simple terms, make sure to subscribe to the Wisdom channel and turn on notifications so you never miss our next video. Most people think the stock market is the center of the financial world. But in reality, stocks are only one part of the system. Behind the scenes, there is a much larger market quietly supporting the entire global economy. That market is the bond market. Government bonds are essentially loans. When governments need money, they borrow from investors by issuing bonds. In return, they promise to pay back the money with interest. These bonds are purchased by banks, pension funds, insurance companies, central banks, and large global investors. In fact, trillions of dollars move through the bond market every year. And because governments rely on these loans to fund everything from infrastructure to public services, the bond market has become the foundation of the modern financial system. Which is why something happening right now is causing concern among economists and investors. One of the clearest warning signals comes from credit rating agencies. These agencies evaluate how reliable a borrower is when it comes to repaying debt. When a country receives a high rating, it signals confidence. It means investors believe that government will pay its debts without problems. But when a country's credit rating is downgraded, the message is very different. It suggests that risks are increasing. It means there may be concerns about how much debt the country has taken on. And in some cases, it raises questions about whether the borrower can continue paying those obligations comfortably. Now think about something remarkable. In recent years, even some of the world's largest economies have faced warnings related to their growing national debts. That is not just a financial headline. It's a structural signal that the global system may be under pressure. Because when governments accumulate massive amounts of debt, their options become limited. When a country's debt grows too large, governments usually have only three main choices. First, they can raise taxes. This brings in more revenue, but it can slow economic growth and create political resistance. Second, they can cut spending. This means reducing government programs, services, or investments, something that is rarely popular. The third option is one that has appeared many times throughout history. Governments can increase the money supply. In simple terms, they can print more money. This does not always happen literally through printing physical cash. Often it happens through central bank policies that expand liquidity in the financial system. But the result can be similar. When more money enters the economy, two major effects often follow. First, asset prices tend to rise. Second, the cost of living may increase over time. And this is where many people are beginning to notice something unusual happening today. Look around the world today and you may see a pattern. Housing prices have climbed in many countries. Gold prices have increased as investors look for stability. Food prices have risen in many regions. Energy costs have also experienced significant volatility. Meanwhile, many ordinary savers feel like their money is losing purchasing power. Even if income increases slightly, rising prices often move faster. This creates a situation where people feel like they are working harder but falling further behind financially. And part of that pressure may be connected to changes happening within the global financial system. Most people worry about stock market crashes. But the deeper concern among many economists is something else entirely. What happens if confidence in government debt begins to weaken? Government bonds are not just investments. They are used by banks, pension funds, and institutions as safe assets that support the entire financial structure. They sit at the base of the global financial pyramid. If confidence in that foundation ever begins to crack, the effects could spread far beyond financial markets. And that is why many experts are watching the bond market more closely than ever before. Because sometimes the most important signals in the global economy are not the ones making headlines. They are the ones quietly developing beneath the surface. If you found this explanation helpful, make sure to like this video and subscribe to the Wisdom channel for more deep insights into global economics, world events, and the forces shaping our future. And now we want to hear from you. Do you think the global debt situation could become one of the biggest economic challenges of our time? Let us know your thoughts in the comments below. And we'll see you in the next video.